The indirect method of presenting cash flow from operating activities is widely used in financial reporting because it reconciles accrual-based net income with actual operating cash flow. Unlike the direct method, which reports individual cash receipts and payments, the indirect method begins with net income and adjusts for non-cash transactions, non-operating items, and changes in working capital accounts. The program explains that this approach highlights the relationship between the income statement, balance sheet, and statement of cash flows. By showing how accrual accounting differs from actual cash generation, the indirect method helps analysts understand the quality of earnings and the underlying drivers of operational cash flow performance across reporting periods. Under the indirect method, the calculation of cash flow from operations begins with net income from the income statement. Analysts then adjust net income for non-cash expenses such as depreciation, amortization, and impairment charges because these items reduce accounting earnings without requiring cash outflows during the period. Non-operating gains and losses are also adjusted because their cash effects belong to investing or financing activities rather than operations. For example, gains from asset sales are subtracted from net income because the associated cash inflow is classified under investing activities. These adjustments ensure that CFO reflects only cash generated from normal business operations rather than accounting allocations or financing and investment transactions. Changes in working capital accounts represent another major component of the indirect method. Working capital includes current assets and current liabilities directly related to operations, such as accounts receivable, inventory, accounts payable, and accrued expenses. The program explains that increases in accounts receivable reduce operating cash flow because revenue recognized exceeds cash collected from customers. Similarly, increases in inventory reduce cash flow because cash is used to purchase inventory not yet sold. In contrast, increases in accounts payable increase operating cash flow because expenses are recognized before cash payments are made. Analysts closely evaluate these changes to assess working capital management, collection efficiency, and operational liquidity within the business. The indirect method provides important insight into earnings quality and sustainability. Strong companies generally produce operating cash flow that closely matches or exceeds net income over time. When earnings consistently exceed cash flow from operations, analysts may question the quality of reported profits because accrual-based earnings are not supported by actual cash generation. Large working capital adjustments or repeated increases in receivables and inventory may indicate slowing collections, overproduction, or aggressive revenue recognition practices. By reconciling accounting earnings to operating cash flow, the indirect method helps analysts distinguish between sustainable operating performance and temporary accounting effects that may distort reported profitability and financial health. One advantage of the indirect method is its ability to clearly connect financial statements and explain why net income differs from operating cash flow. This reconciliation improves understanding of accrual accounting and highlights the effects of non-cash transactions on financial reporting. Because the indirect method begins with net income, it is also easier for companies to prepare using existing accounting systems. As a result, most firms worldwide use the indirect method in practice. However, some analysts prefer the direct method because it provides more detailed information about specific operating cash receipts and payments. Despite this limitation, the indirect method remains highly valuable because it emphasizes relationships among profitability, working capital, and liquidity management. The analysis of indirect method operating cash flow is essential for evaluating financial flexibility, solvency, and long-term sustainability. Analysts use operating cash flow trends to determine whether a company can fund operations internally, repay obligations, support dividends, and invest in future growth opportunities. Weak or volatile operating cash flow may indicate operational inefficiencies, excessive reliance on external financing, or declining business performance. By carefully examining adjustments for non-cash items and working capital changes, analysts gain deeper insight into management effectiveness and financial reporting quality. A strong understanding of the indirect method enables analysts to interpret cash flow statements accurately, assess earnings reliability, and make better investment, lending, and valuation decisions in global financial markets.